Welcome back to Talk Tickers. If you're here, you aren't looking for the quick soundbite. You're here for the signal that's buried deep inside the earnings call transcripts.
Exactly. We do the professional summary deep dive for the serious market participant. And today, we are cracking open the books on, well, a pretty controversial sector.
We're talking coal, specifically Alliance Resource Partners, ticker ARLP.
And if you just rolled your eyes because I said coal, I get it, but stay with us. The market action on this name is telling a story that goes way, way beyond just burning rocks.
Yeah, we're looking at the Q4 2025 earnings call, and the immediate reaction was, well, it was confusing, right?
It was bizarre. The stock closed up 3.65% at $24.69, and the volume was just huge.
Huge how?
Over 1.1 million shares traded. Their average is, what, about 184,000?
Wow, so that's a massive liquidity event. The market was clearly voting with its wallet on this one.
It was, but here's the paradox, and this is why we're doing this deep dive. If you just look at the headlines, they missed on revenue. They announced they're closing a mine permanently, and they had some operational hiccups.
And yet the stock rallied almost 4%. That doesn't add up.
In any other sector, tech, retail, that combo gets you absolutely punished. Here, it got rewarded. So the question is, why?
That's the puzzle. It feels like a story about, I don't know, cash engines, maybe extreme visibility on their contracts, and just this macro environment where boring old reliability is suddenly trading at a huge premium.
That's it in a nutshell. So let's start with the headline numbers just to set the stage. What did they actually report?
Okay, lay it on us.
So the bottom line was the shiny object. They reported earnings per unit, EPS of 64 cents.
And the estimate was?
FactSet was sitting around 55 cents, so they crushed profit expectations. A pretty significant beat.
A solid beat on the bottom line usually solves a lot of problems. But you said the top line was a miss.
It was. Revenue came in at $535.5 million. The street was looking for something closer to $555.
So a $20 million miss. And that's down year over year.
Yep, down about 9.2% year over year.
Okay, hold on. Revenue is down nearly 10%, but they beat on profit. How are they squeezing more juice out of a smaller lemon? Is this just all cost cutting?
It's partly cost discipline, which, we'll definitely get to. But there is some accounting noise here that we have to be upfront about.
I figured.
Adjusted EBITDA surged to $191.1 million. That's up 54%. But that number had a little helper.
I hope.
It included $20 million in investment income, specifically a $17.5 million non-cash boost.
From where?
From the fair value increase of a coal-fired power plant they hold an equity stake in.
Wait, let's unpack that. A coal miner owns a piece of a power plant.
They do. It's a strategic stake. And because the value of that plant went up on paper, ARLP gets to book that as income.
It feels a little bit like accounting magic, doesn't it? It's a non-cash gain. It pumps up the EPS, but it doesn't actually put dollars in the bank to, pay the dividend.
You're absolutely right to be skeptical. That $17.5 million is a paper gain, no question.
Okay.
However, even if you strip that out, the actual operational cash flow was still very robust. Distributable Cash Flow DCF was $100.1 million for the quarter.
And for the people listening who own this for the yield, DCF is really the only number that matters.
It's the whole ball game. And their coverage ratio on that was 1.29 times.
Okay, for those who don't speak master limited partnership, explain why 1.29 allows an investor to sleep at night.
The coverage ratio basically asks, for every dollar they promised to pay out, how much cash did they actually generate?
Right.
A 1.0 means they're paying out every single penny. That's risky. 1.29 means they covered that big dividend with plenty of room to spare.
And they kept the distribution the same.
Maintained at 60 cents per unit quarterly, so that's $240 annualized. The payout is safe.
Good to know. What about the balance sheet? All that cash flow is nice, but not if they're drowning in debt.
It's pristine. They're sitting at 0.66 times total leverage.
Under 1 is good. Under 0.7 is.
It's incredibly conservative for a capital-intensive industry like mining.
Okay, before we get into the mines themselves, I have to bring up the weirdest line item on this balance sheet. Every time I see it, I have to double check I'm reading the right company.
I think I know where you're going with this. You're talking about the crypto.
The Bitcoin. They're still holding 592 of them.
Yep. Valued at roughly $51.8 million at the end of the year.
It's baffling, isn't it? A 100-year-old coal company holding digital gold.
It is, but it actually plays into the bigger thesis that we'll get to later. It's this asset that sits completely outside the traditional energy system.
A diversification play, for sure. But let's get back to the rocks. The operational story here seems totally split. He's got Appalachia, which sounded like a mess, and then the Illinois Basin, which sounded like a well-oiled machine.
That's a great way to put it. Let's start with the mess in Appalachia. I call this the localized outage.
Okay.
The headline bad news was the Matiki mine. Management basically pre-announced the death of this asset.
Death of the asset is pretty strong language. What happened?
A key customer just came to them and said, "We can't commit to taking any more tons, period."
Wow.
So Alliance issued warn notices to the staff. Production there is going to cease after March of 2026.
Okay, but mines lose customers. Why close the whole thing? Can't they just go find another buyer on the spot market?
Well, it's not just the customer, it's the geology. They've been mining Matiki for a long, long time. And as you go deeper, the rock above the coal gets thicker, more expensive to support, ventilation costs go up. It just becomes a very high-cost operation.
So it's a double whammy. The main customer walked away, and the cost to pull the rock out was already too high to compete anyway.
Exactly. It was their highest cost, lowest margin operation. So by closing it, they're actually improving the average margin of the whole company.
Addition by subtraction.
Precisely. But Appalachia had another headache in Q4, Tunnel Ridge. This is usually their star performer in that region, but the volumes just tanked.
The outline mentioned a longwall jump. I love the industry jargon. What on earth is a longwall jump?
Okay, picture this. A longwall mining machine is this massive piece of steel that shears coal off the wall. It's hundreds of feet wide.
Right.
Tunnel Ridge had a problem. There were existing natural gas pipelines running right through the coal reserve they were trying to mine.
You can't mine through a gas pipeline. That goes boom.
Right, so they had to stop, dismantle this massive subterranean factory, literally move it around the gas well obstruction, and then reassemble it on the other side.
That's the jump.
That is the longwall jump. It's a logistical nightmare. It takes weeks. And while you're moving the machine, you aren't cutting any coal.
Well, that explains the volume hit,
Yeah.
but that's a temporary problem, right?
Yes. And that is exactly why the market looked past it. Despite everything, Tunnel Ridge is still expected to generate 98% of the Appalachia region's cash flow in 2026.
98% from one mine.
It's the workhorse. It just stumbled for a quarter.
Got it. So Appalachia is messy, but they're cleaning it up. Now let's pivot to the good news. The cash engine. The Illinois Basin.
This is the Hamilton mine story. While Appalachia was struggling, Hamilton achieved record production and record saleable yield. This place is just humming.
And when a mine hums, costs drop.
Drastically. They are guiding for Illinois Basin costs to drop to the $33 to $35 per ton range for 2026.
In this inflationary environment, guiding for lower cost that's impressive.
It really is. I mean, labor costs are up, parts are up. How do you do that?
So how are they doing it?
Well, volume helps, obviously, spreading fixed costs over more tons. But they also highlighted technology. Specifically, they're retrofitting their shuttle cars with something called Infinitum electric motors.
Is that actually significant? Or just, a cool tech demo for the call?
No, it's significant for uptime. In underground mining, if a shuttle car breaks down, the whole continuous miner has to stop. Everything grinds to a halt. These new motors are lighter, they're more reliable, and they're easier to swap out. Less downtime means more tons per shift. And that drops directly to the bottom line.
So we have the bad assets being pruned, the good assets getting tech upgrades. Let's talk about the future, the 2026 guidance.
Yeah.
Because usually in commodities, you have zero visibility. You're just at the mercy of the spot price.
This was the mic drop moment of the whole call.
Okay.
They provided volume guidance for 2026 sales between 33.75 and 35.25 million tons.
Which is actually growing total volumes, even with the Matiki mine closing. That's a neat trick.
It is. But here is the number that really matters. Greater than 93% of that 2026 sales midpoint is already committed and priced.
93%.
93.
Wow. Okay, let me play devil's advocate here. 93% locked in sounds great for safety, but if energy prices spike again, like they did in 2022, doesn't that cap their upside? They're effectively selling 2026 coal at 2024 prices.
That is the classic bear case, and it's a fair point. Yes, they have capped their super spike lottery ticket upside. But look at the flip side.
Okay.
We're seeing natural gas prices go all over the place. We have regulatory uncertainty. By locking in 93%, they have completely shifted the risk profile. The question for them is, no longer will the market crash. The only question is, can we control our costs?
It turns a volatile commodity play into a boring manufacturing play.
Exactly. It creates a floor. And for a stock that's yielding 10%, I think investors would much rather have the floor than the lottery ticket.
Fair enough. But let's talk about that volatility, because Mother Nature clearly didn't get the memo about stability. We started 2026 with that Arctic blast.
We did, and this is so crucial for understanding why the stock rallied after this call. In January, we saw that massive cold snap. Natural gas freeze-offs hit record highs.
17 billion cubic feet of gas went offline. Can you just pause on freeze-offs? Why does gas fail in the cold?
It's just physics. Natural gas comes out of the ground with water vapor in it, and when the temperature at the wellhead drops to, say, -10, that water freezes inside the pipes and valves. The well literally chokes itself off.
So exactly when you need the heating fuel the most.
The supply vanishes, and that sent spot prices to the moon.
Hub gas prices hit $100. That's crisis-level pricing.
It is. And while all those gas wells were frozen solid, what was the coal doing?
The coal pile was just sitting there.
The coal pile was just sitting there. Solids don't stop working when they freeze. Coal supplied 40% of the power in MISO and 24% in PJM during the absolute peak of that crisis.
It was the literal backup generator for the entire grid.
It was. And here is the real alpha for listeners. On the call, management explicitly said that their 2026 guidance did not factor in the benefit from this Arctic blast.
Wait, what? So the guidance we just called solid and de-risked doesn't include the massive price spike from January?
Correct. So if they had any spot tons available, or if their contracts have some index-linked pricing, they likely sold that coal at the very, very top of the market. It suggests the guidance is conservative.
So there's hidden upside. Now, weather helps in the short term, but the long-term narrative has always been coal is dead, manage the decline. I got a very different vibe on this call. They weren't apologizing for being a coal company.
No, the apology tour is over. The narrative has completely shifted from energy transition to energy dominance.
They mentioned the political landscape pretty explicitly.
They did. They referenced the Trump administration's Energy Dominance Council, but more importantly, they brought receipts. They noted that utilities in 19 states have now reversed or delayed the retirement of 31,000 megawatts of coal capacity.
31,000 megawatts. To put that in perspective, a big nuclear plant is maybe 1,000 megawatts. So that's like 31 nuclear plants worth of power that was supposed to shut down that is now staying online.
It's a staggering amount of capacity, and it's driven by two things. One, the reliability fears we just talked about, and two, the sheer terror of AI load growth.
Okay, let's connect the dots to AI, because usually people buy NVIDIA to play AI. They don't buy a coal miner in Tulsa.
Well, they should be looking at the plumbing. PJM, the grid operator for a huge chunk of the industrial U.S., held their capacity auctions. The prices hit the absolute cap.
So they offered the maximum money possible.
Right. They offered the max, and they still fell short of their own reliability targets by 6.5 gigawatts.
They offered top dollar and couldn't buy enough insurance for the grid.
The cupboard is bare. We are physically short of reliable power. And these AI data centers, they need 247 baseload power. You can't train a massive language model if the power dips because a cloud went over a solar farm.
So the data centers are what's keeping the coal plants open.
It's a necessity. The conversation has moved from how fast can we close these dirty plants to if we close these plants, the internet breaks.
Right.
And that creates a structural floor for coal demand that just didn't exist 2 years ago.
It's fascinating. You have a company throwing off cash with a locked-in order book in a market that has suddenly realized it desperately needs the product it spent a decade trying to ban.
It's the ultimate contrarian setup.
And speaking of contrarian setups, I think it's time for the segment our lawyers hate the most.
Let's do it.
This is not financial advice segment. We are not advisors. We are just two people looking at a screen and hallucinating trade ideas. If you do this, you will probably lose all your money.
Absolutely.
But if you are a hedge fund manager trying to capture this specific moment in history, what's the trade?
Okay, so take off the analyst hat, put on the doomsday prepper hat. I call this trade the AI apocalypse hedge.
The AI apocalypse hedge. I am listening.
The thesis is simple. The grid cannot handle the AI boom. We are going to see brownouts, price spikes, total chaos.
Okay, scary, but plausible.
So the trade is this. You go long ARLP. But you don't view it as a coal stock. You view it as grid failure insurance.
Explain the mechanics. Why this specific ticker?
Think about what you are actually buying with Alliance. It's a weirdly specific hedge fund wrapped in a coal mining ticker. I call it the barbell of the beast.
The barbell of the beast.
Yeah,
Okay,
like-
walk me through the assets.
Asset 1, coal. If the grid wobbles, coal pricing spikes. It is the fuel of last resort. When the lights flicker, this asset prints money.
Sure.
Asset 2, oil and gas royalties. They have record volumes there. If geopolitical tension explodes or inflation runs hot again, oil and gas are going to rip. You get paid.
Check.
Asset 3, the crypto. The 592 Bitcoin. This is your system failure hedge. If the fiat system gets shaky or the dollar devalues, this is your exposure to the digital lifeboat.
It really is a bizarre collection of assets for one company.
It is the ultimate anti-ESG portfolio. I mean, think about it. Scenario A, the grid collapses from AI load, ARLP wins.
Right.
Scenario B, the financial system gets shaky, Bitcoin wins. Scenario C, everything stays normal and boring. You just sit back and collect a 10% dividend yield while you wait.
And you could juice this, couldn't you?
Oh, if you want to be really aggressive, you go long ARLP and you buy deep out of the money puts on something like NVIDIA.
The logic being,
If the grid fails, the whole AI trade collapses because you can't run the servers, the high-flying tech stocks crash. But the energy providers, the ones keeping the remaining lights on, they skyrocket. It's a perfect correlation hedge.
that is wild. I love it. It completely ignores the polite conversation about net zero and just focuses on the harsh reality of keeping the lights on.
That's what we do here. We look at the physics, not the marketing slides.
All right, let's bring it back to Earth for a second. Recap the actual earnings for us.
Okay. ARLP delivered a mixed headline, missed the revenue, beat the profit, but a very, very bullish signal. The bad assets are being pruned, the good assets are humming, and the order book is 93% locked in for 2026.
De-risking the cash flow,
Yeah.
and the market reaction told the story.
Up over 3.5% on massive volume. Investors are voting, and right now they're pricing in energy security over energy transition timelines.
And that really is the bottom line. The world needs power, and right now, Alliance Resource Partners is selling the reliability that keeps the servers running and the heaters on.
Just remember, do your own due diligence. We are just reading the tea leaves here.
Absolutely. This has been Talk Techers. Thanks for diving deep with us. We will catch you on the next earnings print.
Stay sharp out there.